Now to join us to talk more about Syria, the U.S. economy, the markets, and how investors should position their portfolios, we are pleased to welcome Mohamed El-Erian. He's the CEO and co-chief investment officer of Pimco, the world's largest bond fund. Mohamed, always a pleasure to see you. Thanks for joining us tonight.
Thank you, Bill.
Let me ask you, there have been other geopolitical issues in the last few years around the world, and I think most recently of the toppling of the Morsi government in Egypt. And for the most part, the markets didn't blink on those events. Today, they blinked big time. Why do you think that is?
A simple reason, Bill, and the oil market tells you why. As Susie said at the beginning, Syria doesn't produce much oil, 50,000 barrels. That's a margin of error in the oil market. However, Syria is connected regionally. It's a battlefield for a proxy war that includes Iran, Iraq, Qatar, Saudi Arabia, Lebanon, and Turkey. So the concern that the markets have is that the Syria instability and all the human tragedies there will have adverse regional effect that will destabilize the oil market and then impact our economy.
All right, so Mohamed, there is Syria. That's very important. But also, as you just heard in all of our reports, there's the negotiation over the debt ceiling. There's also all this Fed stuff going on, tapering, a new Fed chairman coming up. As you look at all of these trouble spots, which could be most disruptive for the markets and the U.S. economy?
So the most disruptive thing is for many of them to happen. So at our last count at Pimco's investment committee, we identified 8 important uncertainties. You've already mentioned 3 of them: the debt ceiling, the continuing resolution, and Syria. In the last few weeks, you've been talking about 2 Fed uncertainties: who will succeed Chairman Ben Bernanke, and will the Fed taper, and how? And then let's not forget Europe and Japan. So when we put the whole picture together, there's a lot of uncertainty that the market is now starting to price in.
But your area of expertise, at least at Pimco, would be interest rates. And right now you're getting cross currents for interest rates here in the United States. On the tapering side, rates will rise. If this conflict with Syria escalates, rates presumably would go down. Which way do you think they're going in the near term here?
So in the very near term, they're more probably to go down than up. And the reason why is because they overshot on the way up. Let's also not forget that, unfortunately, Bill, our economy is not attaining escape velocity. We're still stuck in second gear in a 1.5% to 2% growth rate. So that also puts downward pressure. So the market overreacted, and understandably so, but overreacted to talk of Fed tapering. And now other factors are playing in. Over the long term, if you're talking many years, we're going to have to normalize interest rates at some point.
All right, so last time that you were on, Mohamed, you were saying that investors should walk away from risk. You said don't run, just walk away from risk. At that time, rates on the 10-year were rising. What's your advice now?
So the walk away from risk at that time was really from the equity market. Don't run. There was still further to go, and it did go further. We've only started selling off in the last few weeks. And the idea was a simple one. For a long time, the market's investors have been riding this huge wave of central bank liquidity. And the market believed that this wave would continue and would overcome all sorts of obstacles, if you like, all sorts of rocks in the ocean. And now we're realizing that wave is not so certain because the Fed itself is worried about the collateral damage. And in addition, there are other things. So we caution those investors who still believe that the Fed can deliver everything. The Fed has done a lot, but it cannot deliver everything at this point.
Very quickly, Mohamed, gold is rising again. It's a safe haven play. It's a wild card. Would you buy gold here?
So I think having 3 to 5% gold in your portfolio at this level of price is a good idea. It's a hedge. It's an important hedge. And I think that a well-diversified portfolio should, at these prices, have a 3 to 5% share of gold.
Mohamed El-Erian of Pimco, always good to see you. Thanks for joining us again.
Thank you.